One thing you'll quickly learn about me is that I don't trade based on hope, guesses, or what I want the market to do. I trade what I see: structure, liquidity, price action, and probabilities. And in today's session, I'm going to explain step by step how those elements lined up for this sell setup, where I'm planning to take it, and under what conditions I'd change my bias entirely. By the end of this breakdown, you won't just know my trade idea. You'll understand the reasoning behind it, the flexibility needed to manage it, and why, as traders, we never marry our analysis. The market is in control. Our job is to read it, adapt to it, and execute with discipline. I'll take you from the broader market context, zooming into the finer details, and explain not just what I'm looking at, but why I'm looking at it. So, starting right at the weekly time frame, we can clearly see that price has been in a strong, well-defined downtrend for quite some time now. This isn't just a short-term retracement. The structure shows consistent lower highs and lower lows, confirming the bearish momentum in the market. Now, what makes this weekly chart even more interesting is the strong horizontal support level sitting down here towards the bottom of the chart. Every time price has come down to this area, it has reacted quite aggressively, bouncing away almost as if buyers are waiting there in large numbers to defend that level. This is not something we ignore, because these kinds of levels often tell a deeper story about order flow and market sentiment. Now, zooming further into the 4-hour time frame, and this is where I get more tactical about my entries, you'll notice that price has been retracing into an area of interest where I'm actually considering a sell. The key here is that I'm not just selling blindly. I have multiple reasons that line up to give me confidence in this setup. First, if we take a simple trend line and draw it from the most recent swing highs, we can see a pattern that I personally love to trade: my typical 3 touches. The first touch sets the tone, the second confirms the trend line's validity, and the third touch is often where the most high probability reversals happen. Next, let's talk about this resistance zone over here on the left-hand side of the chart. This zone has acted as a barrier for price multiple times in the past, and because of that, I mark it as a liquidity point, a place where price likes to hunt for stop losses before reversing. And guess what? Recently, price has pushed up just enough to take out the previous high sitting inside that liquidity zone. This is a classic liquidity grab. Market makers push price above a key level to trigger breakout buys, scoop up those stop losses, and then reverse it back down. From here, the reaction is exactly what I wanted to see. Price has started dropping nicely to the downside, confirming that sellers have stepped in and that the liquidity grab was successful. I don't just jump in as soon as I see a reaction, though. I want to make sure that the move is backed by momentum, strong bearish candles, preferably breaking minor structure levels along the way. That's exactly what's happening now, which aligns perfectly with my bearish plan. I've already entered my sell positions here based on everything we've just analyzed. Now, I want to be completely transparent. It's still early in the trade, and at this stage, nobody can say with absolute certainty exactly what's going to happen next. This is one of the realities of trading that many beginner traders either don't understand or choose to ignore. You see, analyzing the market is not about predicting the future. It's about stacking probabilities in your favor. That's what separates calculated trading from pure gambling. Here's the thing most beginners miss. Analysis is not a magic spell that forces the market to follow your direction. You can never fully eliminate risk from trading. Risk is a permanent part of the game. But if you have a proven, well-tested, and systematic strategy, one that you've refined over time and that consistently gives you a statistical edge, you start to understand that each trade carries risk, but it's a calculated risk. You're not pressing buy or sell out of hope or fear. You're making a decision backed by logic, structure, and rules you trust. The problem is, many new traders believe that just because they analyze the market and found a setup they like, the market must follow their direction. They get emotionally attached to their bias. But here's the truth. Real traders don't try to force the market, they follow it. So, what I'm looking forward to right now is for price to drop at least down to this level here, the one I've marked out in advance. If price can get there, that would complete what I call my typical 3 touches on this structure. And only once that third touch is in place, that's when I might start shifting my focus from a bearish mindset to scanning for potential buying opportunities. This is key, because I'm not trying to guess the bottom. I'm letting the market show me when it's giving me a valid reversal setup based on my rules. But as things stand right now, I'm still in my sell position. My main target remains that lower level we discussed earlier, but I'm also realistic enough to know that I might close earlier if price action starts telling me a different story along the way. See, nothing in the market is fixed. Targets are not set in stone, and flexibility is just as important as having a plan. A lot of traders make the mistake of locking their eyes on one target and refusing to adapt, even when the market is clearly showing signs of changing direction. That's how small losses turn into big ones, or small profits get wiped out completely. For me, I'm constantly reading the live price action as the trade unfolds, watching the candle structure, the momentum, and the reaction to key levels. If the price starts stalling, printing reversal signals, or breaking short-term structures against my bias, I'll take that as a cue to secure what's on the table rather than hoping for the full move. The market is a living, breathing thing. It moves in waves, not straight lines. The more you respect that, the more consistent you become. That's why I approach each trade with a clear plan, but remain ready to adapt if the story changes. For now, I'm simply letting this sell play out, keeping my eyes open for the kind of price behavior that could either push it to my final target or tell me it's time to bank profits and step aside. And just as I predicted, price is dropping beautifully in my direction. This is exactly the kind of follow-through I was expecting based on the analysis we went through earlier. However, I'm going to go ahead and close my position here. Not because I think the move is over, but simply because I have other pressing matters to attend to and I don't want to leave the trade unmanaged. Now, based on the structure and momentum, I'm confident that price could drop a bit further from here, possibly even reaching that key target level we discussed. But one thing I've learned over the years is that trading isn't just about squeezing every last pip out of a move. It's about managing your trades according to both market conditions and your own availability. If I can't give a trade my full attention, I'd rather take my profits off the table than risk unnecessary exposure. So, I'll happily walk away with a clean, well-executed trade, knowing the setup worked exactly as planned. Sometimes the smartest move isn't to chase the market. It's to lock in your gains, close the chart, and come back fresh for the next opportunity. So, I came back to check the charts and noticed that price still has solid potential to push further to the downside. Because of that, I've decided to get back in the market, and I'm now currently holding 2 sell positions. From here, my plan is simple. I'll be managing these trades closely, watching how price behaves as it approaches key levels. Now, there is a support level sitting not too far below current price, and I'm aware it could act as a reaction point where buyers might try to step in and push price back up. This is exactly why I don't just set and forget. I monitor the trade and stay ready to adapt. But as things stand right now, momentum is still on our side, structure is still bearish, and the market hasn't given me a reason to exit yet. So for the time being, I'm comfortable holding. My eyes are on price action. If it starts showing signs of reversal, slowing momentum, or breaking short-term bullish structure, I'll take that as my cue to start scaling out or closing completely. Until then, it's about letting the market do its thing while sticking to the plan.